Welcome back to Top Tech and Trades channel. Ark Invest has lost more than half of its value since its peak in 2021, prompting many investors to abandon the fund. Investors are frightened to touch any of Ark's ETF now that prices have dropped significantly, and many are shorting them. Ark's flagship ETF, ARKK, has dropped from a peak of nearly $27 billion to a current value of $12 billion. This is surprising because lower pricing are typically associated with larger predicted future returns. Cathie Wood, CEO of Ark Invest, feels we're at a pricing position that offers one of the most significant opportunities in the existence of the stock market. Many investors preferred internet stocks in the dot-com bubble to Ark Invest, but Cathie believes that skeptics are totally off the mark. Our current position is analogous to the dot-com bubble, but with the tables turned. During the dot-com bubble, internet equities rose dramatically, while value stocks plummeted. After the dot-com bubble burst, value equities outperformed growth companies. From 1999 to 2004, the Nasdaq and Berkshire Hathaway's returns are compared on the graph on the screen. While the Nasdaq plummeted, Berkshire Hathaway stock steadily rose in value. Cathie Wood believes that we're in a similar situation, but the roles are flipped. Cathie sees 2022's innovative stocks as the value stocks during the dot-com bubble, and 2022's value stocks as the internet stocks in 1999. Although it may appear strange, the performance spread between the two funds is pretty close. Over the past year, ARKK is down roughly 50%, whereas Berkshire Hathaway is up over 30%.
I think I mentioned on the last In the Know that the ratio of new lows to new highs was as high as it's been since 1999. And in 1999, it was the value stocks that were hitting new lows as everyone was racing into the internet. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s when that ratio behaved that way was to move away from the new highs into the new lows. And I think the same is true today.
Price changes are fascinating to study, but what goes down does not always have to come back up. The macroeconomic background, on the other hand, is laying the groundwork for a big rally in Ark Invest. The Federal Reserve is going to raise interest rates. Most economists believe that a 0.25% increase will occur in March, but some actually think that a further rate hike will occur. Traders are currently pricing in a 30% chance for a 0.5% rate increase. This is because the latest job report came in much higher than expected. Economists expected 150,000 new jobs in January 2022, but the US ended up adding 467,000 jobs instead. That is a substantial difference and is signaling that the economy is strong right now. The unemployment rate, which has maintained around 4%, has also been low. Jerome Powell, the Fed chair, recently stated that he believes there is a lot of room to raise rates while the economy continues strong. Bank of America recently stated that it sees 7 rate hikes coming in 2022. One rate hike is typically 25 basis points or 0.25%. So 725 basis point rate hikes would be a 1.75% increase. That is a very bold take among banks and economists. Bank of America cited a Fed statement that it's behind the curve on raising rates as a sign of future paying to come. M2 money, which includes cash, checking deposits, and easily convertible money, has begun to decelerate in a monthly basis. The coming rate increase in March and the fear of future rate increases are starting to be priced in the ARK's valuation. If and when inflation cools down in response to these types of rate hikes, growth stocks will be in a fantastic position to rally. The challenge is how many rate hikes will be required to keep inflation under control. Cathie believes that the fear of rate increases is exaggerated and that not many rate increases will be necessary to slow down inflation. Other economic factors that we'll soon cover are also at play and will influence the Fed's actions.
Many people, after today's employment report, are beginning to think that 50 basis points is the number, that the Fed will basically telegraph that it means business and that it's going to head inflation off at the pass. They may do that. And if they do, however, we think the stars are aligning in such a way that they will get the message very quickly that they don't need to do much more. Another break on them is political year, the midterm elections. The Fed does not like to get in the middle of midterm elections, doesn't want to be accused of any political dynamic. So they might want to do the 50 basis points just to say, okay, we're done for a while. Now, what's interesting about the market's reaction to this possibility is that strategists out in our world are now trying to leapfrog each other, saying, okay, I think it's at least 3 more tightenings after that, or 4. I've even heard altogether 7. So the reaction you've seen in the equity market recently is fear, I think, that the Fed is going to go too far, too fast, because as I will go through in a minute, the economy is quite weak. And I think the Fed could overdo it quite quickly.
If Cathie is correct, the Fed will not need to raise rates as much as most believe. Then ARK will see significant upside value readjustments. If the Fed raises rates by 50 basis points in March, that would be an incredible opportunity to purchase innovative stocks. This is because the future outlook would be positive for Ark Invest, as future rate increases may not be necessary. Returning to Cathie's prior .com comparison, value stocks have been steadily rising month after month. Ford stock is still trading at a 5-year high despite the recent sell-off, while financial and energy equities have also been climbing over the last year. The Vanguard Financials Index Fund is up 28% in the past year, and the Vanguard Energy Fund is up 52%. Such increases are obviously not sustainable for slow-growing stocks. This is a sign that there is a massive value stock bubble based on the fear of a repeat of the .com bubble. Cathie used Ford as an example of the value bubble because of its increasing mobility and valuation.
I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it expected, its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space, but to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What that move said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales base is gas-powered cars, and we believe that the shift toward electric is accelerating here, oil prices being one reason, but also lower prices being another as battery costs come down. So I found that very interesting in the context of the juxtaposition of the late 90s against today.
Cathie actually believes that only big tech will be hit significantly by increasing interest rates because, according to her, smaller innovative companies can outgrow an increase in interest rates. The CEO of Social Capital, Shamas Palihapitiya, also mentioned this once as well. Shamas said hypergrowth companies would outgrow a marginal increase in interest rates and therefore continue to thrive. If a corporation is growing at 50% per year, a 2% increase in interest rates combined with lower valuations will limit compound interest power. However, it would have little impact on the company's long-term prosperity. If a company is growing at 15% per year, a 2% increase in loan rates will be disastrous. Over the course of 10 years, a corporation growing at 50% per year would increase revenue by more than 28 times if discounted at 10% each year. When discounted at 15%, the company's revenue would only grow by 20 times. That's a considerable difference, but it's nothing compared to the impact that the company growing at 15% per year would have. A simple hack to calculating how long it takes for a number to double is to use the rule of 72. According to the rule of 72, 72 divided by the rate of growth equals the number of years it takes for a number to double. If a company's revenue grows at a rate of 15% per year, it will grow at a rate of 5% per year if the revenue is discounted by 10%. As a result, we can divide 72 by 5 to get 14.4 years. When the company's revenue is discounted by 10%, it takes 14.4 years for the revenue to double. When a company's sales grow at 15% per year and is discounted by 12%, the company's revenue grows at 3% per year, which implies it will take 24 years for its revenue to double. The extra 9.6 years to double is awful for investors, which demonstrates that disproportionate impacts that increasing interest rates would have on larger tech companies. Cathie believes she found a signal pointing towards this outcome.
Now, I have spoken to some really good value investors, who've been doing this all their lives, and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be hit? And the answer that I found most interesting, and that I think we've just seen in Facebook, is it would be the more mature growth companies that are facing some competition, and not the super growth companies that are just entering into their exponential growth trajectories. So again, another argument for new growth. Think Amazon early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%, say 25%, which is what happened. Nobody believed it was possible. Then given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal. We are in that same place with truly emerging growth right now. And the private markets know it, because private market valuations have only gone up over the last year. A paper gathering the data on this right now, but in the last year, as true disruptive innovation strategies depreciated 50% or more, private market, which is which focuses on disruptive innovation, private market valuations seems to have doubled. There's really something wrong with that picture. And I think the private markets have it more right. There's more innovation taking place today than there ever has been in history.
Many retail investors invested in ARK in 2021 are now dumping the ETF, but that's the exact opposite of what one should do. Benjamin Graham, the author of The Intelligent Investor and the mentor of Warren Buffett, once described short-term movements as emotional and counterintuitive. When the market is too bullish, according to Graham, investors should attempt to sell their positions. When investors are gloomy, this is the time to invest in equities. That isn't a simple formula, and more research is required. But it's an idea that all investors should consider, regardless of their expertise or knowledge. That being said, Cathie may be wrong, but if she's right, investors in ARK are about to make a boatload of money. Leave your comment down below. If you enjoyed this video, please hit the like button and subscribe. This is your Top Tech and Trades channel, and I'll see you in the next one.